Hey everybody, welcome back to the show. We have another edition of 5 Question Friday, which I think folks have been enjoying. I've been enjoying putting them together. And we've got 5 incredible questions this week. I love them all. They come from the live show where folks put questions in the chat that I don't get to. They also come from emails that you all send me. So 5 great questions. Let's dive right in. The first one, and I'm kind of surprised that folks haven't asked me this question before. I think this is the first time anyone has asked me this question since I've started this YouTube channel. And it's, should we factor in taxes in our asset allocation? In other words, should we do an after-tax asset allocation? And let me explain what that might look like. Let's imagine we have $100,000 in a traditional IRA and $100,000 in a Roth. And we want a 50-50 portfolio. 50% stocks, we'll just say those are in the Roth. 50% bonds, we'll put those in the traditional. What folks that are promote the sort of after-tax asset allocation would say is, wait a minute, you don't really have a 50-50 portfolio on an after-tax basis. Sure, the Roth is tax-free, assuming you follow all the rules, but that traditional IRA, you're going to owe Uncle Sam money when you pull money out. Let's just assume over time it's 25%. And so, yeah, you have $100,000 in there, but it doesn't all belong to you. 25,000 of that belongs to Uncle Sam. And so really, you don't have a 50-50 portfolio. You've got 100,000 in stocks. And once you pay Uncle Sam, 75,000 in bonds. And so the idea would be, hey, within the Roth, let's sell some of our stock ETF. We won't pull it out, of course. We'll leave it in the Roth, but we'll move it over to bonds to get us a true after-tax 50-50 allocation. That's sort of the idea. And I'll say right up front, I disagree with it. I think it's totally unnecessary to think about your asset allocation on an after-tax basis, even though I agree it has some initial appeal, not unlike the bucket strategy, by the way. Now, before I tell you why, let me give you some articles. I'm going to link to everything below the video. Let's see here. Here's the first one. This is an article by William, I don't know how to pronounce it. I guess it's Reichenstein. I don't know how to pronounce it, but he's written a lot about this. He is a big proponent of after-tax asset allocation. He's written many articles. This is just one of them, but I'll leave a link to this one below the video. And then on the Bogleheads, the wiki, they have a whole section on tax adjusted, they call it, asset allocation, and sort of their thinking behind it. And it's not often I disagree with the Bogleheads, but this is one case where I do. And let me explain why. It is true that both the timing and amount of taxes that you'll pay for a traditional retirement account are linked to that account. It depends on when you pull the money out, whether you do so by choice because you need to spend it, or perhaps you're not even going to spend it, but required minimum distributions force you to pull some money out. Maybe you just stick it in a taxable account, but either way, that's going to dictate the timing of your taxes. And then, of course, how much you pull out in your tax situation in the year you pull the money out. And the tax laws at that time will also, of course, dictate the amount of your liability. And so I think at least initially, there's some real appeal to tying that liability to that account and factoring that in when you do your asset allocation. But I don't think that kind of mental math makes sense or is necessary. You can think about that liability as standing by itself. You're going to owe taxes. We know that. You may or may not pay it from the money in your traditional IRA. For example, let's imagine we take out $10,000 one year from a traditional IRA. We're going to spend it. That's what we need. We need $10,000 of spending money. And it's going to trigger $2,500 in taxes. Well, where are you going to pay that $2,500 from? Well, you might pull more money out of your traditional IRA. Of course, that'll trigger even more taxes. You got to figure out what that final number would be. That's one way to do it. Or you could just say, I don't want to trigger any more taxes this year. So I'm going to take the $10,000 out of the traditional IRA, but I'm going to pay the tax bill out of the Roth because that's tax-free. So I'll take the $2,500 out of there. Well, now what do? Were we correct in attributing that liability to the traditional IRA, even though we're going to actually pay it out of the Roth? Or maybe you've got money in a savings account. You're just going to pay the taxes out of a traditional account. So how do we factor all of that in? And of course, a traditional retirement account is not the only kind of account that has embedded tax liability. So does a taxable account, of course. as you might have unrealized gains, and they could be taxed at different rates depending on your circumstances and level of income in a given year. And you could even have different investments within a taxable account with different levels or amounts of unrealized gain, so that selling one investment might trigger a lot of taxes and selling another might not trigger any at all. And so wouldn't we have to factor all of that in as well to come up with this after-tax asset allocation? I think we would, and it gets immensely complicated. But there's a more fundamental reason, and that is there's really nothing special about the taxes we pay when we take a distribution from a traditional retirement account. For example, should we do an after-tax asset allocation adjustment for the real estate taxes that we'll pay and the sales tax that we'll pay? I mean, yes, they're not associated with one of our investment or retirement accounts, so we kind of think of them separately, but it's still taxes and it's still money coming out of our accounts. I can assure you, when we send $1 out of our checking account, it doesn't much care whether it's going to Uncle Sam in the form of income tax or a local government in the form of real estate tax, or frankly to the grocery store for groceries. Money's going out. I think trying to do your asset allocation on an after-tax basis is a solution looking for a problem. It just doesn't exist. Money is fungible. There's no reason to do it. At least that's my take on it. It was a great question a viewer emailed in. But again, people disagree with me, and I go back to these articles that I mentioned. I encourage you to check them out. Maybe you'll disagree with me, and that's okay. All right, great question. All right, question number 2. Also dealing with asset allocation. Should you include the value of your home in your asset allocation? And I would add to that, should you include the value of rental properties if you own rental properties in your asset allocation? For me, by and large, the answer is no, and I'll explain why. First of all, I would absolutely include your home as well as rental properties in any sort of net worth statement. I would also include those things in retirement planning. So, for example, if you use software that we've talked about on the show, like Bolden or Projection Lab or what have you, they would definitely be assets in that I would include in the software. With rental properties, I would actually include, I would certainly include the stream of income, and maybe on a net basis, but the cash flow that you're getting every year would absolutely be included in that planning. I might include it, and this is what we do in Bolden. We use the equity in our home. We sort of say we're going to use that for assisted living, sort of end-of-life sort of healthcare needs. That's one way to look at it. You might even think about a reverse mortgage, and you can model that in Bolden as well. So I would absolutely include it in retirement planning. But I wouldn't include probably either in the actual asset allocation, particularly when you're getting near and into retirement. And here's the reason. Once you factor in all of your other sources of income, again, it could be from rental properties. It's not going to be from your primary residence, I suppose, unless you rent out a room, but it would include Social Security, pensions, annuities, and that sort of thing, maybe part-time work. You're still left potentially with some additional amount of money that you need to pull from your investments on an annual basis. Now, when you do that, you're by and large not going to pull that money from the value of your home. I know in theory you probably could with maybe a home equity line of credit or a reverse mortgage line of credit, but putting those things aside, when you pull money out, it's not coming out of your primary residence, and it's also probably not coming out of your rental properties. You know, you don't typically sell a fraction of a home that you own. It's coming out of your IRAs, your taxable accounts, and your other investments. And that's where I like to think about asset allocation in terms of the amount of money I need to pull out each year. And as we near the 4 or 5% range, and yeah, that goes back to Bill Bengen and the 4% rule, I think it's really important, in my view, to have an asset allocation that's around 50 to 75% in equities. Yes, that's a wide range. There could be other factors that would cause you to narrow in on what's right for you. But to me, that's how you should be thinking about asset allocation, particularly as you get near and into retirement. Of course, if you don't need that much, maybe you're only taking 1 or 2% of your investments each year, then you've got a lot of flexibility as to the asset allocation you're going to choose. And I just don't see any reason to muddy the waters with trying to throw in there the value of real estate. Now, could you consider it in other ways? Sure. Let's say you've got a lot of rental properties. Maybe you decide not to invest in REITs, although most REITs are not residential REITs, so one could still argue that REITs would make sense even if you own a lot of residential real estate, perhaps. Of course, you may own commercial real estate, and then maybe REITs don't make as much sense, but you could certainly include it and factor it in a little bit in that way. But I don't think I would actually try to incorporate it into your asset allocation. At least we don't, and that's my approach. All right, great question. Third question. Should we tilt our portfolio, and I'll explain what I mean by that, should we tilt our portfolio towards small cap value stocks? These would be small companies that are considered value, meaning they're not growing by leaps and bounds. Maybe their companies have been around for a while, but they're a good value. The price of these companies relative to their earnings is relatively low. You can certainly invest in a number of index ETFs and mutual funds that focus on small cap value stocks. It's something that Paul Merriman talks a lot about and is a big believer in. And I will tell you, for a long time, I did just this. I tilted my portfolio towards small cap value, and by 10%. Today, I feel less inclined to do so. I do have some exposure to small cap, not small cap value. But I've come to believe that probably tilting a portfolio towards small cap value, for me anyway, is not something that I would want to do. I certainly don't think it's a mistake, but I don't think that I've changed my view on that. Probably 10 years ago, I would have definitely had exposure to small cap value. Today, I don't feel strongly about it. Why? Well, I'll show you. We're looking at Portfolio Visualizer, and we're looking at asset allocation portfolio going back to 1972. And I've got two different portfolios. One's just 100% U.S. stock market, and one is 90% U.S. stock market, 10% U.S. small cap value. Now, at 10%, we might say, is it a big deal? That doesn't seem like that much. Well, it's not a huge deal, but over time, now remember, this is over 50 years, so it's a very long time, it made a slight difference. U.S. stocks returned 10.74 annualized return, whereas by adding 10% small cap value, it bumped it to 11%. And it made, over a 50-year period, about a $300,000 difference. But one might say, hey, Rob, I'll take it, right? Why not? And this sort of, not this exact modeling, but something similar to this is what caused me to tilt my portfolio for a long time to 10% small cap value. What I've since come to believe is that tilting your portfolio towards anything, small cap value, large cap, tech stocks, growth stocks, will sometimes outperform and sometimes won't. And certain tilts can outperform for a very long time, but then they can underperform for a very long time. And let me show you what I mean. If we change the dates, so we'll go to settings. Let's first go to 2000. Let's just look at this century. I guess technically that would be 2001, but we'll start at 2000. See if we can get this to work. There we go. Now, if we start at 2000, we're going to see that it still outperforms. Small cap value, of course, the numbers are a lot smaller because we're dealing with 24 years, but 7.99 versus 7.73. Again, not a huge difference, but a difference, and why not tilt towards small cap value, right? Except that we know that the tech bubble burst, and 2000, 2001, and 2002 were rough years. And in fact, if we look at year by year, we can see that both portfolios were down, but the 100% U.S. stock, the dark blue line, was down more. And so if we come back up here and make another change to the time series, and we'll start it, we'll get past the tech bubble bursting. So this is still over 20 years of data. Now when we go to it, small cap value hasn't helped. It's slightly lower. Again, not a big difference, just 6 basis points, not a big deal. But its standard deviation, its volatility was actually a tad higher. Again, not huge. At the end of the day, I wouldn't rely on this, but this is a 20-year period where small cap value has not outperformed the U.S. stock market. And I think it's in part that experience that led me to conclude, I don't think it's a mistake to tilt towards small cap value. And some would argue because of the lagging performance over the last 20 years, now is an ideal time to tilt towards small cap value, not unlike maybe today's an ideal time to have some international exposure. I don't argue with that. I think the real key for me is pick something you can stick with no matter what. And if that includes 10% small cap value, you'll get absolutely no objection from me. As to whether that will turn out to have been a smart move, I think over some periods of time, the answer will be yes. And over other periods of time, the answer will be no. At the end of the day, I don't know of anything that's, of small cap value that makes it somehow unique among all of the different types of ways to subdivide the U.S. or international markets that somehow makes it special and better than the others. Sometimes it outperforms, sometimes it doesn't. Okay. Great question. All right. Fourth question. This has to do with building a TIPS ladder where you buy TIPS bonds that mature, say, some amount each year over some period of time versus just investing your fixed income into an index ETF and keeping it simple. And the viewer wanted to know, if they had $500,000 for their fixed income portion of their portfolio, what would be better? So here's my approach. And again, like so much in all of this, there's no one right answer. It comes down to, I think, preference. But from just a simplicity, ease of dealing with it, I much prefer index mutual funds or ETFs for our bond portfolio. We tend to divide half of it in just an intermediate term U.S. bond fund and half of it in primarily intermediate term TIPS funds. It's easy. 2 funds and I'm done. I don't have to worry about reinvesting the TIPS ladders as some come due. I don't have to worry about managing the duration of the ladder's portfolio. I can just let the bond funds do it for me. The one possible exception is if you're looking for sort of, I'll call it guaranteed income to meet a very specific purpose. So one example might be bridging the gap between when you retire and when you want Social Security to start. And so you want some money that will basically fill that gap. Let's say you're going to get $20,000 a year in Social Security. So you want to get $20,000 back from a TIPS ladder over, let's say, the 5-year period, just as an example, between when you retire and when Social Security kicks in. I could see building a TIPS ladder for that 5-year period to take care of that. That makes sense to me. And the point there is, as TIPS mature, you're not reinvesting them and extending the ladder. You're actually using it each of those 5 years until Social Security starts to fund your retirement. Another way that a TIPS ladder might make sense is you might want a certain amount of guaranteed income to cover your fixed, basic necessary expenses in retirement. So you've got Social Security, maybe you have a pension or annuities, or maybe even a part-time job, but there still may be some additional income you need just to cover your necessary expenses. And I could see building a TIPS ladder to do that, maybe even one as long as 30 years, depending on how old you are and how long your retirement plan is, which is just a nice way of saying how long you think you'll live. The thing that I like about TIPS ladders is you still control the money, unlike with annuities, where you give the money to the insurance company. With a TIPS ladder, you still control the money. There's nothing that's requiring you to leave it alone for the full duration of the TIPS ladder. You could go in and sell TIPS whenever you wanted to if need be, but if you didn't and you just wanted to keep it for the income, you're sort of guaranteed, or at least as close to a guarantee as we can get in this lifetime, that you're going to get a certain amount of money on an inflation-adjusted basis to meet those necessary fixed expenses. To me, that makes a lot of sense. But beyond that, just for long-term investing, I personally just prefer the simplicity of index funds. All right. Great question. They're all good. The fifth and final question, Roth conversions. So this is specific to Bolden, which is one of the retirement planning tools that we talked about. I'll show it to you on the screen in a minute, but it would apply to just about any retirement planning tool that you would use, Prelana, Projection Lab. And here was the viewer's question. They said, look, in Bolden, I can change the assumptions that I make about the rates of return for my different retirement accounts. And they noticed that when they changed that assumption, it changes the Roth conversion strategy that the tool is recommending, and they wanted to understand why. So let me first show that to you. So this is my demo version of Bolden, and I've got a couple of accounts here. This is a traditional 401k with $1 million in it, a Roth IRA with $1 million, and a brokerage account with $500,000. They're all set to the same return, which is important. If you set the assumed rate of return for these accounts differently, that will influence the Roth conversion analysis. And so, and right now we're set to optimistic. Is that right? What's the average? Let me go to average and pessimistic. Let me make sure I've set this up right. I haven't. 9%, pessimistic 5%. I thought something looked wrong. Let's get this straightened out. So I'm using 9% as optimistic return, 5% as pessimistic. The percentages don't matter much for our purposes, just that they're different. And so right now I've got it set at average, so I'll make it optimistic. So they're assuming 9%, and we're going to go to Explorers and Roth conversion. And we have different approaches. Let's try lowest lifetime tax liability. And this question's important, by the way. This question says, look, in terms of the tax that you're going to have to pay with a conversion, do you only want to pay it out of taxable accounts, or is it okay if you also pay it out of the conversion money that you get? So effectively, you'd have to withdraw more out of your IRA if you select this yes, potentially to pay some of the taxes. I always select no. You can also set a minimum that you want Bolden to leave alone in your taxable account. In other words, don't drain all of my taxable accounts to pay the taxes. And that may make sense in your planning, but I'll just leave that alone for now. And we can see the optimization. And in this case, it's suggesting 5 conversions over the next 5 years. And you can see the difference in tax liability between our plan as it was plus this proposed Roth conversion strategy. But to the viewer's question, let's change the forecast. So we can see it here. Let's go to average. We saw a change. We could dig into the details of the exact changes, but let's for the moment just note that it changed. And if we go to pessimistic, it changed again. It actually looks like it dropped it down. And one question, or the big question, is why? Why is the optimized plan changing when we change effectively our rates of return assumptions? And I think there could be multiple reasons, but I think the main reason is that the rate of return that we assume will dictate the amount we have in our traditional retirement accounts once we reach the age where required minimum distributions start. And so the more we have in traditional retirement accounts at, let's say, age 73 or potentially 75, the higher the required minimum distribution, that in turn can raise our taxes, right, at that time. And it can even put us into a higher marginal tax bracket, higher marginal tax rates. It can affect other things like IRMA and taxes on Social Security. So it can have sort of cascading effects throughout our tax liability. And that in turn can affect the Roth conversion analysis. And so the one thing I wish all of these tools did was gave us more insight into exactly how these calculations work. It's not something that by and large these programs do, but I suspect that when you're seeing different Roth conversion analysis results, when you assume different rates of return, it's in part, and maybe significantly in part, or a significant reason is the difference in the traditional retirement account balances when you reach the required minimum distribution age. That's my belief, my best guess. Again, I can't say that there aren't other factors, but I suspect that is a big one. So great questions this week, and I learned a lot researching many of them. If you have more questions, certainly leave them in the comments below. I'll do my best to help you out any way I can. And until next time, remember, the best thing money can buy is financial freedom.